What if the same forces that shaped past economic crises are at work again? The S&P 500 just entered its first correction since October of 2023, dropping 10% from its recent high. Meanwhile, gold is breaking $3,000 an ounce, something unprecedented in market history. And this isn't a coincidence. And in this video, I'm going to show you why gold is surging, what happened to the economy the last 3 times that gold had a rally like this, and the specific moves that I'm making with my portfolio right now. And I'll also show you how I've removed my data from dozens of websites with the sponsor of today's video, but more on that later. What if I told you we've seen this gold chart before? The one that's making headlines right now isn't new. It's practically a replay of a financial drama that unfolded half a century ago and transformed how an entire generation thought about money. If we hop into our financial time machine and go back to 1973, bell bottoms were in style, Watergate was dominating the news, Nixon removed us from the gold standard, and something remarkable was happening in the gold market. During that recession from 1973 to 75, gold didn't just rise, it exploded upward by a staggering 87%. And this wasn't just some random market move, it was a direct response to the economic chaos that was unfolding around it. Picture this. Americans were lined up for blocks at gas stations, sometimes waiting hours just to fill their tank. The oil crisis had brought everyday life to a crawl. Inflation was eating away at savings accounts like acid through paper. And the stock market, it was having one of the worst periods in modern history. Sound eerily familiar to anything you're seeing today? Now, what made the 1970s so unique and so relevant to our situation now was this toxic combination economists called stagflation. You've probably heard of it. It's when you get high inflation and economic stagnation at the exact same time. This means that prices go up while the economy stops growing. The warning signs from the 70s look like they were copied and pasted into today's economic news. We're seeing inflation concerns that had many economists worried about hitting double digits, and we've experienced energy disruptions from global conflicts affecting supply chains, as well as geopolitical tensions. If you just turn on the news from the Ukraine to the Middle East to rising concerns about Taiwan, the geopolitical risks are everywhere. And what's politically striking is how the Federal Reserve behaved then versus how it behaved now. In both eras, we see a Fed that initially dismissed inflation concerns, remember the term transitory, and then scrambled to catch up with aggressive interest rate hikes. And back then, the Fed chair, Arthur Burns, started with tentative measures before having to take more drastic action. And today's Fed, under Powell, seems to be reading from the exact same playbook, starting with assurances that inflation was transitory before launching the most aggressive rate hiking cycle in decades, as well as quantitative tightening. Now, here's where it gets really interesting. The market reactions are following almost identical patterns. In the 1970s, the initial rate hikes that caused market turbulence, just as we saw in 2022 and 2023. But as gold started its move upward precisely when investors realized the Fed was fighting a difficult battle against persistent inflation, which is exactly where we find ourselves today. So why are gold prices breaking records right now? It's not just some random market movement. Gold is responding to the same economic warning signals that triggered that massive 1970s rally. The precious metal serves as a kind of economic smoke detector, and right now it's beeping loudly. The surge we're witnessing suggests we may be entering an economic phase remarkably similar to that difficult period 50 years ago. And when you overlay the gold price charts from 1973 to 1975 with today's, the similarities are downright spooky. Both show the same pattern of testing previous highs, breaking through resistance levels, and then accelerating upward. And this isn't just technical analysis, it's history giving us a preview of what might come next. What's particularly telling is that central banks worldwide are buying gold at rates that we haven't seen since the turbulent period in the 70s. And they're not doing this for decoration, they're preparing for economic uncertainty and perhaps the economy tanking. And when people who control the world's money supply start stockpiling gold, it's probably a good time to start paying attention. And it's also worth noting that if you're enjoying this content so far, liking the video and subscribing is a free way that you can show support, and it's much appreciated. Now, central banks aren't the only ones who've learned to rush toward gold when trouble looms. During the 2008 financial crisis, as ATMs went dark and retirement accounts disintegrated, everyday investors who pivoted to gold watched their portfolios gain over 70% while the rest of the market crumbled. And here's what's even more concerning. Today's banking sector is showing the exact same stress fractures that appeared right before that collapse. Let's rewind to 2008. Remember the gut-wrenching feeling when Lehman Brothers filed for bankruptcy? That was September 15th of 2008, a day that sent shockwaves through the entire global financial system. But gold's journey during this period tells a fascinating story. When the crisis first hit, gold actually dipped as investors scrambled for cash to cover other losses, and that initial drop fooled many into thinking gold wasn't the safe haven everyone had claimed. But then something remarkable happened. As the crisis deepened and confidence in banks evaporated, gold began a steady climb that would continue for the next 24 months. From the chaos of the banking collapse, gold emerged as the ultimate financial shelter. While your neighbors watched their 401ks get slashed in half, gold investors saw gains of over 70% during this exact same period. And this wasn't just a coincidence, it was a pattern that's repeating itself right now. What's particularly unsettling is how similar today's warning signs are to what we saw back in 2008, because back then we had regional banks showing early signs of stress months before the big names started failing. Sound familiar? Today, regional banks are once again flashing warning signals. Think of banks like Silicon Valley. With commercial real estate exposure creating vulnerable balance sheets, we saw several regional bank failures just in this past year, and the sector still hasn't recovered fully. And if you look at the exact price movements from 2007 to 2011, it reveals something crucial about timing. Gold didn't just shoot up overnight, it built up momentum gradually as the crisis unfolded, kind of like how it's been doing for the past 4 to 5 months. The smartest investors didn't wait for headlines announcing financial crisis in big bold letters. They instead recognized the early warning signs, like perhaps what we're seeing now, and positioned themselves accordingly. And that's the key lesson here, is that method and timing matter. During 2008, investors who purchased physical gold early in the crisis outperformed those who waited until panic had fully set in. Similarly, those who chose gold mining stocks see even more dramatic gains in the recovery phase, though with obviously substantially more volatility and risk along the way. Financial advisors successfully navigated clients through the 2008 meltdown, understood this dynamic. For example, Lee Baker, president of Claris Financial Advisors in Atlanta, noted that during the crisis, clients were desperately seeking tangible assets like gold because it feels more real than stocks and bonds. And this psychological comfort factor shouldn't be underestimated when the markets are in a free fall. The strategies that worked best weren't simply buy gold and forget it. The most successful approaches involved gradually increasing gold allocations as banking stress indicators worsened, then strategically converting some of those positions back to equities as recovery signals emerged, things like quantitative easing. And it was this dynamic management, not just blind allegiance to gold, that protected wealth most effectively. Now, today's market shows disturbing parallels to those pre-2008 conditions. We're seeing stress in the commercial real estate market, regional banking concerns, and the same kind of investor nervousness that preceded the last financial crisis. Add to this the renewed threats of trade wars and recession fears, tariffs, and you have the perfect recipe for another gold surge. And what makes the current situation so alarming is a combination of factors at play. You see, the banking sector stress alone might not trigger a gold rally, just like a market correction in isolation might not do it either. But when you combine banking concerns, market volatility, recession fears, and global trade tensions, you create the exact kind of perfect storm that sent gold soaring after 2008. And that's precisely why investors are flocking to gold today. They recognize these combined warning signs and remember what happened last time and haven't forgot. Gold has a long track record of holding its value over millennia when financial systems falter. As one of my favorite investing phrases goes, gold is the only financial asset that isn't simultaneously someone else's liability. Investors in 2024 aren't just reacting to headlines, they're responding to the same instincts that drove people toward gold in 2008. When uncertainty reigns and traditional investments look shaky, gold becomes not just an investment, but financial insurance or a hedge. The current price movement suggests that many are taking out that insurance policy right now, and many people are also taking action to remove their private data from online websites and data brokers with the sponsor of today's video, Delete Me. Now, this is a service that I personally use, and they've removed my personal information from dozens of sites, and with data breaches becoming more common than ever, that is why the sponsor of today's video, Delete Me, is more important than ever, because it helps you remove your personal information like your name, address, phone number, email, and more from data broker websites that buy, sell, and trade your data. And the process is simple. Simply submit your information, and within 7 days you receive a report showing exactly where your data was found and removed. Delete Me continues to monitor and remove your data all year long, and I can tell you from personal experience that it actually works. You can get 20% off of all US plans today by heading over to the link in the description down below and join the thousands of people who trust Delete Me to protect their online privacy and take control of your data today. Now, that financial insurance policy I mentioned, well, you'll want to pay close attention because its premium right now is skyrocketing for a reason. You see, When you look at what's happening with gold right now, we're witnessing something truly unprecedented. A perfect storm of both market forces that's sending gold on a trajectory that has even veteran analysts updating their forecasts on the fly. This isn't just another market cycle, it's a confluence of factors we haven't seen before. And what makes today's gold rally fundamentally different is the unique combination of forces all pushing in the same direction. Massive central bank buying, Trump's new tariff announcements, as well as technical breakouts are all happening simultaneously. And while any one of these factors could move the gold market, but all three together are creating these record-breaking price movements. And the most eye-opening development is how central banks around the world are stockpiling gold at astonishing rates. These are systematic accumulations that signal something deeper than just routine portfolio adjustments. Because when the institutions responsible for maintaining our global financial system start hoarding gold at historic levels, they're telling us something about their confidence in the current monetary system as well as the stock market, and it tells us they're preparing for something. This central bank buying is happening alongside Trump's confirmation of reciprocal tariffs on all countries. This announcement triggered what analysts at FX Street called a last-minute flight to safety. These tariffs inject massive uncertainty into global trade relations, and investors run to gold when uncertainty rises. And what's particularly fascinating is watching gold's technical chart patterns develop in real time. You see, gold is smashing through resistant levels like a dam finally breaking under mounting pressure, and recently gold bulldozed through the daily R1 resistance at $3,096, as well as the R2 resistance at $3,108. And these clean breaks signal extraordinary buying pressure, with the next targets at $3,130 as well as $3,150. Major investment banks are taking notice, including Goldman Sachs, which recently raised their gold target to $3,300 by year end, citing higher than expected central bank demand as well as strong ETF inflows. Bank of America projects $30.63 per ounce in 2025 and $33.50 in 2026. And perhaps most striking is Macquarie's group forecast of $3,500 an ounce by the third quarter, driven largely by concerns about America's growing deficit. And this consensus amongst financial giants matters more because it often precedes broader market movements that individual investors can capitalize on. The evidence extends beyond forecasts to money flows. Global physically backed gold ETFs saw inflows totaling $9.4 billion in February alone, according to the World Gold Council. And that's the strongest month since March of 2022. And this indicates serious institutional money seeking safe harbor. Now, despite gold's rapid price appreciation, option pricing on gold is actually getting cheaper rather than more expensive. This usual divergence suggests traders aren't fully pricing in the upside potential, leaving room for additional gains as the market catches up to reality. Taking all these drivers together, unprecedented central bank purchases, trade tensions, technical breakouts, major bank upgrades, and accelerating ETF inflows, we're seeing a unique market environment for gold that hasn't been seen before. And the typical gold rally might give you 30 to 40% gains over a couple of years, but current conditions could produce something even more significant. Based on converging analysts' forecasts and technical signals, gold has a realistic pathway to reach $3,500 by next year, with multiple resistance levels already broken and money continuing to flow in, and few technical barriers remain in its way. Psychological barriers at round numbers like 3,200 and 3,300 will likely create temporary pauses, but the underlying momentum suggests these will be brief consolidations rather than reversals. And with gold breaking through resistance levels left and right, you might be wondering if it's too late to add it to your portfolio. And here's something most people miss. During the COVID recession, when markets were in freefall, gold quietly gained 28%, while supposedly safe investments were crumbling. But there's a specific approach to gold investing that historically outperformed all others, and almost nobody talks about it. You see, gold deserves special attention when you're trying to recession-proof your finances, because gold functions as a sturdy anchor in the stormy sea of market volatility. Its independence from other assets becomes its superpower during market chaos. When stocks tank, gold often rises, creating a counterbalance that can keep your portfolio from free-falling during economic storms. And my analysis of performance data from previous recessions revealed that investors who allocated 5 to 20% of their portfolio to gold consistently fared better than those who ignored precious metals entirely. The optimal allocation isn't a one-size-fits-all. Think of your portfolio like a recipe. Each ingredient just serves a specific purpose. Just as salt enhances flavor but becomes overwhelming in excess, gold provides stability in the right proportion. disproportion. Your personal risk tolerance as well as your financial goals should dictate exactly where in that range you fall. For example, someone nearing retirement might want to be closer to that 20% mark, while younger investors with time to recover from market dips might be more comfortable at 5 to 10%. Now, not all gold investments deliver equal results. Physical gold has tradition on its side, but ETFs and mutual funds offer convenience and liquidity that bars and coins can't match. These investment vehicles eliminate the traditional headaches of physical ownership, like storage, security, insurance, or finding a buyer when you want to sell type of concerns. Gold IRAs prove particularly effective, letting you capture gold's benefit inside a tax-advantaged retirement account. The strategy allows you exposure to gold potential upside without the logistical challenges of physical ownership, eliminating broker fees, transportation costs, and security concerns that most people holding physical gold would concern themselves with. Now, during recession periods, gold's relationship with other investments becomes crucial for building resilience. While most assets move in lockstep during market panics, gold often breaks the formation and heads in the opposite direction, and this negative correlation makes gold very valuable during economic uncertainty because it zigs when everything else zags. Now, gold mining stocks offer a different proposition altogether. You see, they act as amplifiers of gold movements. When gold prices rise 10%, mining stocks might actually jump 20 to 30%, and this leveraged exposure comes from mining companies' fixed costs. When gold prices increase, their profits can explode disproportionately. The downside is that when gold drops, mining stocks can fall even harder. Now, the biggest mistake investors can make with gold is timing. Don't be the person who only reaches for an umbrella after the storm has already hit. Too many wait until recession headlines dominate before adding gold, and by then prices have typically already made significant upward moves. The smart money establishes positions before everyone else rushes for the exits. In today's environment, mirrors the classic precursors to gold's outperformance: banking sector stress, inflation concerns, as well as geopolitical tensions. And we're also witnessing unprecedented factors like massive central bank buying and de-dollarization trends that could amplify gold's recession performance. The data is compelling. Gold has averaged a 45% gain against the last 3 recessions. With today's unique cocktail of economic factors, gold could match or exceed that performance in any upcoming downturn. As we wrap up today's deep dive on gold, we've seen how this precious metal has reliably performed through various economic storms. Historically, gold has been seen as a hedge against economic instability, inflation, as well as a declining currency, and that's exactly why it deserves consideration in your portfolio today. So whether you're concerned about inflation or market instability, gold consistently serves as that financial fallback plan that smart investors maintain as a small allocation of their portfolio. And the golden rule remains: preserve your hard-earned wealth through diversification, because in every economic storm, gold stands as a potential financial lifeboat. So how will you diversify your portfolio? Please let me know what you're doing in the comment section below. And one last thing that's worth mentioning is if you're interested in any of the merch featured on this channel, like the hoodie I'm wearing now, or another one of my favorites, the Defund the IRS tank top, perfect for those workouts when you want everyone to know how much you hate paying taxes, there's a link in the description for your convenience. Thanks for tuning in, and we will catch you on the next episode.